Well, good morning, good evening to all of you, and thank you for joining us for this fireside chat with Carl Tannenbaum, Chief Economist at Northern Trust, to discuss perspectives on the economy in the wake of COVID-19. My name is Adam Cotter, and I head up the Asia office of OMFIF here in Singapore. Now, to manage and have the best flow of the conversation, Carl will begin with a presentation, which will be followed by a short discussion between Carl and myself. We anticipate this taking 30 minutes altogether, and we will then use the remaining 30 minutes for Q&A with our attendees. During the Q&A, we, of course, warmly welcome participant interaction, so please do feel free to send in your questions to my colleague Angela at angela.lee@omfif.org. And there will also be 3 polling questions asked, and we look forward to getting your responses to these throughout the session as well. Now, this is a good time to remind you all that you would have heard this is being recorded and is an on-the-record conversation held under the OMFIF rules, further information of which can be found on our website. Now, Carl, many thanks for joining us today. I hope you can hear me clearly and we can hear you clearly.
That sounds wonderful, Adam. Thanks.
Great, Carl. Now, perhaps you can get us started with your presentation on the big picture and provide a global economic and markets outlook. We can then later on dig down on some of the specifics around fiscal monetary policy, geopolitics, and the like later on. Please, over to you, Carl.
All right, excellent, Adam. Thank you very much. Good morning or good evening, wherever you're joining us from. Hopefully you will be able to see the slides up on your screens now. It's a pleasure to join all of you, as I've been doing for the last couple of months during these sessions. I want to begin by wishing that all of you are staying safe and well during these very uncertain times for our health and our economy. I certainly hope that we'll have the opportunity to look back on this and draw some important lessons from a posture of full recovery on both fronts. As you can see, I've titled the remarks "Ill Winds," which are a pretty good way of describing the economic climate that has fallen over the global economy since COVID-19 really became a bigger issue in February of this year. As Adam highlighted, what I'm going to do is just really begin with some high-level views on what's going on globally, and then we very much look forward to your comments and questions later on. We've seen some remarkable things in the last several months. Schools closed, airplanes parked on tarmacs all over the world, places of business, restaurants closed, areas that we would go for recreation, for sport, for entertainment, all inaccessible to us. And we've really been confined to our quarters, many of us, for a very long time. I do try occasionally to find a little bit of humor in all circumstances, and so I share with you these cartoons, which depict the challenges that we have working at home. Everybody has difficulty creating that normal boundary between their home and their work now that they're one at the same. And for many who are really not able to travel far, your home is also your vacation destination. I can relate that in my home, I'm sharing it with my wife and my youngest child, who's 21 and finishing her 3rd year of college. And you can see that while we haven't all been huddled around the kitchen table, we have concluded during the last 3 months that there is such a thing as too much togetherness, and it's a good thing that we have a basement, which is usually where I spend the majority of my time. But I think we realize that we're very lucky. Our family has not been touched by the coronavirus. Our work is ongoing. We don't have to worry about the loss of a job or a business, and so we try and put that into perspective as we contemplate our current circumstance and the environment that's ahead of us. Now, some of the pictures that we get on the global economy have not been nearly as funny. Many of the data series that we follow have the quality shown in the upper left of numbers that simply fell off a cliff beginning in March. This is a very commonly cited economic statistic called the Purchasing Managers Index. It has 2 important qualities. It covers most major countries around the world, and it's easy to understand. A rating of 50 and above indicates economic advance, and a rating of 50 and below illustrates potential for economic contraction. And you can see, as shown by the recent history, this series in some countries has set all-time lows, a series that usually only moves by 1 or 2 points in a given month. And this is very serious because of what it means on the bottom left for people who are at work, or in this case, not at work. Excuse me, we have seen a remarkable increase in the number of unemployed people, while some national statisticians have chosen to not include people who are supported by government retention programs in these numbers. I think in most major economies, we are seeing unemployment rates functionally that are well over 10%, and here in the United States are approaching 20%. And so this is clearly something that is going to take a big toll on the economy, because people without jobs typically are unable to continue spending and are dealing with an uncertain future. So what will it take for us to achieve a full recovery, both medically and, more importantly, for tonight's discussion or this morning's discussion, economically? Well, the way we're thinking about it at Northern Trust is that there are 4 curves that we'll have to keep a close watch over. And those curves will describe the trajectory of the economic recovery that hopefully we have in front of us. The first of those curves is that traced by the virus itself. So we are watching increases in cases for countries and even regions within countries very, very closely. And you can see some of the data for Asia on the chart here. China was first into the coronavirus crisis, took some very aggressive actions, and has definitely lowered the number of cases it is facing. But as many of you know, there has been a renewed outbreak reported from Beijing itself, which has promoted some additional measures of containment. I think this illustrates what we're seeing in other markets, which is that you're going to have to get used to a little bit of stop and start, because this virus is still not very well understood. How long is it latent in carriers? How often do you have asymptomatic carriers, and how long does immunity last? All of these things are being studied by biologists intensively. Around the world, you can see a handful of countries where cases are rising very rapidly. And here I would include many in Latin America, India, and unfortunately, I'd have to add the United States to the list, where the number of cases has accelerated rapidly following the reopening that we have seen in the economies of several of our largest states. So this is clearly something that we're still trying to get a fix on. The uncertainty surrounding it is certainly a factor in economic behavior. And before leaving the slide, I do think we all owe a great debt of gratitude to those in the medical professional who are caring for those who are sick. The next curve is the one that'll be followed by governments in determining how open they should be and under what restrictions they will be open. You can see from the upper left, there's an outfit at Oxford University that has been compiling measures of openness for the world as a whole, and also for countries, and even sub-levels within countries are highly recommended if you're interested. And you can see that we've seen some steady movement towards reopening, but I think there's a caution, because nobody wants to have to reimpose restrictions, which is what is happening in China and the United States as we visit this morning. In addition, there really does need to be a recognition on the part of all of us, the public, that when we say reopening, that does not mean to go back to the normal behaviors that we had before. Masking, distancing, washing of hands, all of this remains very, very important and does need to be reinforced. There is a temptation, I sense, in some parts of the world to hold back on the restrictions so as to preserve economic activity. I think that can be a little bit dangerous. It's a very difficult trade-off. Evidence that we have from past pandemics show that countries that can be patient are ones that will have the better long-term economic and market performance. The third curve is the one that will be followed by businesses in reaction to the first 2 curves. It's often been said that companies will take public health warnings or openings as one piece of evidence, but they have to make their own decisions about whether they should reopen. They have a series of questions that I've listed here. Is there enough demand? Is there material coming into the factory at one end? Is there sufficient shipping going out the other end? If you're operating a service business, how many people do you need back in the office? Do you have to make physical changes to the facility as shown in the upper left here by plexiglass dividers in a manufacturing plant. And in an office space, obviously there are issues related to the elevators as well as the configuration of the desks. Different workers will have different sensibilities, and so taking a temperature on their willingness to come back to work is another complication. And so in the lower left is a sort of a sorting of businesses by their nature as to how fast things will reopen versus others. And let's just say that I'm not sure that we're going to be going to the fitness centers as often as we did before the coronavirus anytime soon. So the quote at the bottom, I think, is one of the best ones that I've heard. I gave a presentation to chief executives from some of Chicago's top companies a couple of months ago, and one of them said, if you think closing an economy down was hard, reopening it is much more difficult. And then finally, if conditions reopen, we as consumers have decisions to make on whether we feel comfortable getting out and about again. There are a number of surveys that have been taken as to what we feel comfortable doing and not doing, and some of the results are captured here. Particularly interesting is the one on the lower left, which covers some of the major Asian countries, and asked respondents, how comfortable are you going back to doing certain things, going to the groceries and going to hotels. And you can see that there's clear evidence that not everybody is ready to get back on mass transit, to stay in a hotel, to go to a movie theater, or to get on an airplane. And that traces a very, very slow recovery for some of those industries. In addition, we are tracking some longer term trends that may change the nature of the economies around the world themselves. We'll probably have more meetings like this and fewer business trips. Colleges and universities around the world will probably have to incorporate more distance learning as a matter of course. We'll certainly be doing much more e-commerce, which has been rising anyway. And then I think many who had not been very fond of cooking are learning to do so and finding that they like it. And so again, if you add up all four of these curves, Adam, my message to everyone is that this is not going to be that V-shaped quick recovery that everybody is hoping for, but rather it's one that's going to take a little bit of time. And after a burst of energy in the reopening, we'll probably have a number of quarters before we get back to the performance levels that we had before the pandemic. And recognizing this, policymakers around the world have been taking action. This first chart shows the degree to which governments have expanded their budgets to spend to compensate for lost incomes, to help businesses stay in business, to fund the necessary public health measures that are really going to be very, very important. Now, obviously, debt is a subject that needs to be handled very carefully. In the emerging world, maintaining debt levels is really very critical to preserving the value of a currency and making sure that you don't have capital outflows. You can see on the bottom, a number of Asian countries do have rising levels of debt to GDP, and the ones that came into this episode with higher levels of debt obviously have reduced flexibility to address it. I think, though, that for those who are worried about how much governments are spending, all I would offer, Adam, is that if governments had not stepped forward, we might have had a much worse scenario for the global economy. And in order to make that easier, central banks around the world, large and small, have been stepping up to finance the relief efforts by buying more government securities and by lending directly into their home economies. They've committed to doing much more than they did, much faster than they had in the 2008-2009 crisis. Certainly in Japan and China, these have been very active efforts, South Korea as well. And one of the more interesting regional cases that we're watching is Indonesia, which is trying to start its own quantitative easing program, which would be the first of that scale that we've seen in a truly developing economy in quite some time. So that collaboration between treasuries and central banks seems to be working well. Certainly in the long run, an independence between the two is important, but that's a conversation I feel for another day. Now, there are some areas that continue to concern me aside from the general business cycle. First, emerging markets, as I've highlighted before, some of them are very reliant on global trade, have already accumulated debt that was uncomfortable, have not necessarily the highest quality of governance or business practices, and they are the ones that might be the most vulnerable to capital flight. I should throw in that a handful of them also have very difficult times with the coronavirus itself. Once capital begins to leave a country, it's very hard to get it back in. And so I do think that international organizations like the International Monetary Fund and the World Bank are going to be very, very busy trying to resolve the most difficult cases. Global energy producers might fall into that category, even though Brent crude is back to around $40 a barrel. That is below the level that many major producers need in order to balance their accounts. So we do see some so-called petrostates who are having a difficult time. And then finally, while markets by and large have performed quite a lot better than I thought they would, equity markets in particular, and credit markets are functioning much better than they had in the middle of March. There are still some isolated areas in the credit markets that are off sides a little bit and where defaults may yet occur. So we're just going to have to watch those and see whether those defaults can be contained or whether they will carry over and create contagion to the rest of the economy. And so to sum up, Adam, this is our most recent set of forecasts. I should have adjusted because the International Monetary Fund came out with an updated set of forecasts just last week in which they downgraded the outlook for the globe this year and next. There are considerable headwinds and uncertainties that are not helping the economy. And so we're going to need to continue, I think, to be very aggressive from a policy perspective and very patient from an investment and a business perspective as we try and work our way through the next several months and quarters. And so that's the view from here. If you'd like to take the reins back, I'll look forward to our conversation.
Thank you very much, Carl. It's an excellent start, and thank you for your different thoughts on that. Now, you discussed the four curves that you are monitoring. I just want to bring in the audience here to ask one of our first polling questions. Hopefully you can see that on your screens. But we have one of the first questions is about the recovery. And we'd like to get your views on what kind of a recovery you think the global economy will see. And there'll be three options there for you to choose from. So please do contribute to that while we continue the discussions, but it'll be interesting to see the results of that shortly. Now, Carl, I have a pretty extensive list of questions I would like to ask you, but I don't want to monopolize the time at all. So perhaps I can start with just three questions, one on the US, one on the major Asian economies, and then one on monetary policy. I mean, the first one really is to develop what you mentioned about fiscal policy and government interventions. It would be good to hear your take on US fiscal policy and Fed interventions. As you mentioned, ministries, treasuries, and central banks all around the world are funding large amounts of stimulus to combat the effects of the pandemic. But in the US, given how much it differs from that in 2008, and that Jerome Powell has also implied that more government spending might be needed to support the recovery rather than more loans to the Fed, it'd be good to get your thoughts on how you see that panning out in the next sort of 6 to 12 months.
Absolutely. So when the coronavirus first came on the radar screen, I think most of us thought it would be what we call a supply shock, that there would be some factory interruptions in China and perhaps some other countries that would make things complicated, but that we would gradually recover that during the balance of the year. So this was the feeling that it would be short-lived and V-shaped. But as the virus migrated, some of the measures taken to keep us away from one another obviously had a very big impact on business. And so, Adam, from that point, it became a very large demand shock as economies around the world were shut down for some weeks, if not months. When you have a demand shock of that size, it is natural for fiscal authorities to try and step in and replace that demand. And they've done that in a variety of ways by putting cash directly into the pockets of consumers, which was done here in the United States as well as Japan, by offering employment supports to keep people either at their jobs by supplementing their reduced wages or by offering them increased benefits. And the thought is that that money actually will be spent very, very rapidly and keep the economy going. So while it's expensive in the short term, as I've highlighted, I think for the countries that have done it, they're realizing that it would have been more expensive to do nothing and have the economy continue to spiral down. What I want to highlight, though, here and elsewhere, is that many of the programs that were first implemented to deal with the coronavirus assumed that this would only be perhaps a 2 or a 3 month episode. And as I've described, it looks like it could be many months or even quarters. And so some of the programs that are helping are coming up for renewal sometime very soon. And so even though this whole episode has been very expensive and debt levels are rising, I do think that governments around the world are going to have an open mind to continuing to match their efforts to the severity of the pandemic itself.
Thank you, Carl. Can we get the results of our first poll on the screen? So there we are. How does that take you, Carl? No great surprises, or are you more surprised that our attendees are slightly more cautious against the V-shaped recovery?
So Adam, I'm having a bit of difficulty seeing the results. Could you give me the highlights?
Sorry. So we have 3% for V-shape, we have 41% U-shape, and 56% W-shape.
Yeah, that aligns with my expectations. I wish we had more of a V and less of the other shapes. Of course, the W is the one I think that we're all very worried about, where you do have an important second wave of the viral infections. Again, it's not just the impact that will have on citizens, which of course we need to think about, but if you are a business, it's very difficult to plan. Oh, there it is. It's very difficult to plan for activities when you don't know what the landscape is going to look like. I also think, unfortunately, that all of this has prompted a lot of finger pointing between countries that I don't think is very productive. And that also is going to, unfortunately, be a lingering after effect of what we're seeing here.
Yeah, it has been somewhat of a low point in terms of international relations in the last few months. Maybe now we can move on to the next poll question. We have a question on the long-term impact on global trade, and it'd be good to get the attendees' thoughts on what the long-term impacts would be from the pandemic on global trade. So if we can get that on the screen too. And you'll see there's 3 answers for you to choose from: very little, moderate, or significant. So we'll come back to that shortly as well. But while we're talking about trade, I think we must mention the 2 major Asian giant economies. Of course, we've got China as a very socialist market economy and is very efficient in engaging with policy transmission to deal effectively with these types of shocks. India, of course, has a very different system that has huge future growth potential, but there are questions over the country's ability to contain the virus, and we are seeing worrying numbers coming out of that country every day. Such a big impact on India could result in a major 5 to 6 year setback if it were to get into any trouble. Carlo, we did get your views on where you see China and India going in the next 6 to 12 months as well.
Happy to, Adam. I'll begin with China, which I think is dealing with a wide range of forces as it tries to steer its economy forward. I think you accurately depicted their ability to respond to the infection itself. They were able to take some very, very direct and forceful measures, and as a result, were able to get things under control in the affected areas very, very quickly. But I think the damage to China's economy, which will probably be flat this year, which is well below what they had anticipated, could be a little bit more lasting. First, as they get their factories going, a question that I would have is who's going to buy all of that? Because you have Western economies, which are China's clients, which are still very much in the recession phase, trying to get a recovery started. I think as well, it's often said that the pandemic is going to accelerate trends that were already in place. And the whole issue of global trade has been coming under question really since the 2008 crisis, and then with increasing intensity since the 2016 Brexit vote and the presidential election here. China, for better or worse, has been a focal point, certainly in the last month, of countries who have expressed certain concerns about their role in supply chains and other matters. And so it must feel as if the Chinese are under a lot of pressure from without. And so it could be a little bit difficult for them just to ramp back up and expect things to be as they were before. If there is a contraction in global trade as a result of the pandemic and other things in the next few years, China is probably vulnerable to being the biggest loser. Now, India has a completely different profile from China and really is not a competitor to what China has been able to do and can do in some of the heavier industries. But what India has done successfully is create a service economy that can be exported. And so many operations for companies around the world are being done successfully in India. But the challenge is that they still do not have the kind of business and frankly, the public and health infrastructure that will enable them to withstand the kind of challenge that they're having with COVID-19. As you've noted, cases are rising very rapidly. Social distancing is really not an option in a place like India, where you have large urban populations, many of whom are living in very small quarters and crowding onto trains to get back home and the like. I think it's unfortunately going to be very, very difficult from an economic and a public health perspective to get India back to where it was. And I think you're correct. As firms around the world decide where to do business, this episode with India is probably not going to be the best advertising.
And back to China, you outlined some of the policies they're enacting, but do you think China is doing enough, or is it simply waiting around for global demand to rebound? And is this also further clear signs that Beijing is moving away from its sort of export-led growth model?
Yeah, I think China's done a lot, but they are constrained. China is a heavily indebted country. Their debt to GDP ratio has doubled since the year 2009. And a lot of that debt is in some question. Defaults have been rising. There are stories that some of these loans that are packaged into securities sold to the public are now faltering and creating a lot of anxiety in the Chinese financial system. I think they recognize that. They had vowed to get that under better control during the chairman's plenary address in 2017. But I think they're going to have to be very careful about just simply reflating their economy with debt, because they may already have too much of it.
Thank you. Now, Angela, if we could see the results of the second poll question, it'd be a good time to see it now. Carl, I'm not sure if you can see that this time, but I can.
Sure can.
Oh, you can, yes.
Yeah, so I think it aligns with the way I would look at it. I think supply chains are going to come under some important review, both because the pandemic shows that they can be interrupted and you need at least a contingency plan. And then there's a whole issue bound up in that atom of economic security. And the issue that we've had with what we now know as personal protective equipment, which are masks, face shields, gloves, and gowns. China produces, I think, over 60% of the global supply of those things. And when they had the worst of their own pandemic, they were certainly holding a lot of that for their own purposes. And so even to this day, in many countries that are dealing with the pandemic, the supply of that material is still very, very short. What has also not helped is that some of the early shipments that have left China have not been of the quality that certainly the Chinese or others would like. And so I think this is just accelerating a contemplation of a lot of businesses to alter their supply chains, if for no other reason, to be more versatile and flexible during interruptions like we're experiencing.
Yeah, I think what the current crisis has really done is brought to the fore that issue of concentration risk. As you said, there's a lot of dependence on one or two certain areas or supply chains for certain goods. And that's the question that a lot of people have been asking since the pandemic has unraveled too. So I want to come back to policy a bit. For now, it seems that everyone really understands that in the US, Japan, and Europe, rates are going to stay where they are for quite a while. But there are many questions around how policymakers should be clearer on their approach to exiting this kind of extraordinary intervention. It'd be good to hear your thoughts on what you foresee being the long-term political and geopolitical consequences of this, and also what impact it may have on inflation. I have to just go back to that quote you got from one of the business leaders in Chicago about opening the economy. It seems that if central banks thought implementing these extreme policy measures was tough, it's going to be a lot, or how much tougher is it going to be unwinding this policy mix?
So there's a lot to unpack there, but let me begin with the question about inflation. Essentially, in order to keep interest rates low and also to expand their balance sheets by buying government securities and making loans, central banks around the world are essentially running the printing presses. And we've seen very rapid growth in the money supply in a lot of different countries. Many on our call today, I'm sure, have been trained to know that inflation is everywhere and always a monetary phenomenon, that rapid rises in the money supply certainly have the potential to create very high levels of inflation. And as we visit here today, the value of inflation-protected securities and gold are both very, very high. But I'm not quite sure that we're going to have the kind of worrisome inflation that some in the market are expecting. Let's not forget, Adam, that prior to the pandemic, central banks around the world, at least the major ones, were having a very hard time achieving their 2% inflation targets for reasons like globalization, for reasons like e-commerce, which make us much more intelligent consumers. One of the interesting features of the pandemic is that those who don't have to go to the hospital or to a clinic are beginning to use medical services online. And that is absolutely going to cut back on medical inflation, which is a very big part of the inflation picture in a lot of developed countries. And so I think that there are still some secular forces that are going to be pushing down on inflation. And furthermore, central banks around the world are scared to death of deflation. They don't know quite what to do about it. Japan obviously has been in and out of deflation since 1990. And so many central bankers have written and spoken about this asymmetric policy, that they would rather have a little bit more inflation than risk deflation. And if inflation arises, they'll know what to do about it, which is raise interest rates. Now, that's where the political question comes in as to whether it will be easy for central banks who have been working closely with their governments to split from them in order to take measures that they feel are necessary to contain inflation. I know that that question will come up, and it will come up one day in all of our countries, but I would bet that it's not going to come up for quite a while. As Chair Powell said during his most recent press conference, we're not even thinking about raising interest rates.
Yes. How do you think that policy is going to impact the Asian financial systems? Do you think that policymakers in the US and Europe are underestimating the importance of Asia for future global growth?
So that's a great question. I think that is a little bit more of a sort of a geopolitical sort of angle, because central banks, I think, have been trying to work very, very much together. As you know, the Federal Reserve opened up currency swap lines to give access to 14 central banks to the dollars that they need. And so I think members of the monetary community have been coordinating very, very well. On the trade side, the fiscal side, the assistance side, that's where I see a little bit more tendency for countries to go their own way. And this worries me quite a bit because first, I think there are going to be some countries all over the world, some in Asia, some elsewhere, who are going to need international aid to keep them going. And secondly, when countries, are looking inward, they're not looking at opportunities elsewhere. And so I do worry a little bit, because I'm a huge believer in global trade and its broad benefits, that this inward look that so many countries are taking, and frankly, the politicians who are turning a little bit more nationalist, may ultimately turn away from the important opportunities that there are in global commerce. After all, there's immense potential for growth in a lot of the Asian economies, and you're not going to get the same kinds of return and growth trajectory if you stay at home.
Yeah, very much so, Carl. Now, if we could go to our last poll question, and just before we bring this up onto the screen, I do want to encourage all our attendees to submit their questions via email. This can, of course, be done at angelia.lee@omfif.org. We already have a number of questions in, but it's always good to get some more. And then if we could go to our last polling question, this was looking at how governments have been increasing spending and the significance of that to help economies through the pandemic? And will this be a problem in the long term? And we see we have three answers to choose from there: no, somewhat, and yes. And while you're giving your thoughts to that, attendees, will pose a few of the questions we have in from you to Carl. The first one we have, Carl, is from Sweeta Saxena, who's at the United Nations Economic and Social Commission for Asia and the Pacific. And the question is, when the evidence points to L-shaped recovery, why do you believe that the recovery would be W-shaped?
That's a good question. So right now, my base case is yes, it's an L kind of on its side. We get a little bit of a burst, and then it's a little bit of a slow trajectory from there. I think our view is not that dissimilar with those of the IMF, where global GDP may not get back to its level of late last year until the very end of next year. But the W shape that I'm assigning a likelihood to is that we get a little bit of a recovery, and then as we move through the fall, we begin seeing a recurrence of the virus that prompts more stay-at-home orders, more business closures, and potentially that creates a risk that governments who are suffering from what some people know as bailout fatigue are unwilling to continue forwarding as much assistance, thereby letting businesses fail, jobs be lost permanently as opposed to temporarily, and also just some of the supply chains that are just barely operating could ultimately crack if we have a component or two that is not functioning. Now, I am not a biologist. My middle child, my son, is finishing medical school, and he's been telling me all that I know. And certainly he points out that when we have had pandemics like this in the past, it is really quite rare that there is only one wave. And what you can hope for at best is that that second wave is relatively mild. Again, we're seeing the evidence of this virus's staying power in so many different locations where case growth had slowed only to be re-energized.
Thank you, Carl. And a second question we have from Wing Chan, but unfortunately I don't know where they are from, but do you have a view on a realistic rate of return expectation for a basic 60% global bond and 40% global equity portfolio over the coming 12 months? Do you dare have a stab at that?
Yeah, well, it's I'll take the easy way out and say it's lower than it used to be. And that's a real challenge, Adam. And I think one of the things I might have added to my response to your low interest rate question is that portfolios that have certain targets for their rates of return are almost inevitably going to have to take more risk in the years ahead than they might be comfortable with. The reaching for yield phenomenon was, I think, underway, to be honest with you, before the crisis, because central bank rates and government rates were already on the low side. And so as Northern Trust is a global asset servicer and asset manager, and so I work with clients all over the world, and a common refrain was, okay, where can I get the rate of return that I need, whether it's an individual or a pension fund, for goodness sakes, who are really struggling with the aging demographics around the world. And there is no silver bullet. I would have to say, especially after the stock market sprint that we've had, that the outlook for equity returns is going to be cautious, maybe 2 to 4%, and on cash you're barely getting anything if you take a little bit of credit risk. So if you do that blend, I mean, you're looking at something that's 2.5% or less. And I wish I had better news, but that's the way we're thinking about things.
I think that's a very sensible answer, Carl. Now let's go back to that last poll question we posed. Can we see the results of that, please? Can you see that, Carl?
Yeah, I sure can. And I have to confess, Adam, that my parents lived through the American Depression in this country, and I was taught from a very young age that debt was something to be taken on infrequently and paid back rapidly. So I do get nervous about the size of the debt, and I was nervous about some of the debt ratios I was seeing around the world before the pandemic caused them to rise. I think for some countries, those borrowings will be manageable in the long run. And I hate to say it this way, but while we're not managing our finances as well as we could here in the United States, we do have one advantage, and that is the only reserve currency in the world. And we've seen in waves over the last several weeks that when investors are worried about events around the world, they do find some comfort in our treasury securities. And so, while I don't think we should necessarily over-lever that position, it does hold us in good stead. Now, if you go to other countries which have had a longer history of currency volatility and capital flight, running higher levels of debt raises sustainability risk and puts them at more vulnerability for having to go to the IMF, among others, for assistance, which almost always comes with some strings attached and almost always results in austerity that makes it very, very difficult on the population.
Well, thank you for bringing up the role of the dollar, because I have a few questions I would like to ask about that, but also if there's particular countries in this part of the world we should be concerned about. So first of all, you talked about the dollar's role in the global financial system. What's your outlook for the role of the renminbi following the pandemic?
So the Chinese certainly have had aspirations to have their currency become part of the global reserve community. A few years ago, they successfully pursued having it included in the special drawing right facility basket of the IMF, and rightly so. But there are several qualities of a global reserve currency that the RMB still aspires to. It is not freely exchangeable around the world. Its value is carefully controlled by the People's Bank. The international market in RMB-based securities is relatively small, and so you don't necessarily need to own the RMB to be a global investor. And the transparency around it is not, I think, what a lot of currency investors would expect. The euro might have been a candidate. I think Europe is certainly among the regions I'm most concerned about because they've just said goodbye to the United Kingdom. The North and the South are still struggling over what fiscal and monetary policy to pursue jointly. And so the euro does not look like it will be a rival to the dollar anytime soon. So again, what is it they say? The dollar might be the cleanest shirt in the laundry, but still it is looking better than others. My sadness, Adam, is as somebody who normally travels 100,000 miles a year and could possibly take advantage of a strong dollar in local markets, I have been grounded.
That's very true. I agree. The strength of the dollar really is much to do with the weakness of its rivals, be it the euro or renminbi or anything else as well. So I also wanted to come back to your point about particular countries in this part of the world which you feel may be particularly vulnerable from the pandemic. You talked about the issues around IMF bailouts. There is, of course, a lot of stigma around that. You may not want to name specific economies or countries, but do you think there are particular areas that are more vulnerable than others?
So the scorecard that we use, Adam, and we apply these to countries around the world, not just in Asia, takes a look at their levels of debt, their levels of short-term debt, and their ability to roll it over. Whether the countries have debt that is in currencies other than their own, which makes them vulnerable to currency risk. Do they have a good mix of industries? Are they overly reliant on exports or imports? Do they have a concentration to a particular country for one or the other? What is their tradition of fiscal and monetary policy, and is it sensible? And what role do they have in international cooperations where they can, find partnerships that will enable them to get through difficult times like this? From that, you can certainly identify some countries who stand to gain, especially if global supply chains are reoriented. And frankly, in the Asian region, things are already moving in that direction. A lot of people don't recognize that the labor cost advantage that China enjoyed for almost a generation had been slipping away in favor of movement to places like Vietnam, Thailand, even Myanmar. And I think those countries are getting a lot more interest now. I think the challenge that they'll have, obviously, is tentatively sort of diversifying their global trade footprint. without necessarily running too much afoul of their relationship with China, which they still very much need to preserve.
Now, you touched upon portfolios earlier in the question about returns. We have another question here from one of our attendees, from Zoe in Sydney, who represents one of the superannuation funds down there. The question is, do you think the current share market is a bubble? So are we in a current bubble state within the equities market?
Well, boy, if I knew the answer to that question, I would be trading offline here while I'm speaking with you. But here is the best thinking that I've been given by our equity teams. So firstly, equities are looking at a very long-term view of the economy. So I think everybody has it in mind that this second quarter, which will end mercifully tomorrow, is going to be the trough of the global cycle. We're going to see some awful numbers, but we're already in the high frequency data starting to see a recovery. And I think that's what equity markets are starting to look forward to. In addition, when interest rates are very low, the value of earnings out into the future is actually higher because the discount factors are lower. As well, I think that there is some hope that firms will take this opportunity to take a look at their operations. I've certainly heard and read that firms are going to see if they can't make more use of automation, of analytics and artificial intelligence in their operations, which would make them more efficient and also potentially allow them to tap into new products and markets. I think they're going to be reevaluating their headcount and their space needs. So I may not have mentioned it explicitly, Adam, but commercial real estate around the world is something that we need to watch, because I really doubt that all of us are going to be moving back into our office towers anytime very soon. As well, if you take a look at the leaders within the indices, you do see a lot of technology names. And just as we're talking to one another on one of many very, very effective online platforms, the providers of this kind of software that help us get through the pandemic, which may have legs beyond it, are likely to see an increased level of business. So I know our markets very well. The 5 technology companies at the top of the S&P 500 have accounted for an immense share of the rally. And so I'd say that that is the best justification that I have heard. Now, if you take a look at any measure of equity prices versus forward earnings, they do look high in a lot of markets. And there is a lot of risk out there, Adam. And so as you begin to analyze, what is the risk-adjusted return that investors are getting, look, I think there are very, very good questions to be asked and answered. I'm just not sure I'm the best person to give those answers.
Thank you, Carl. So, yeah, I think you really hit the nail on the head with that one. So we have another question here from one of the attendees. I don't have a name. You touched upon it briefly earlier, but do you think there's a risk we've become reliant on central bank intervention during crises, given 2008 and this one? And is this impacting global risk taking? And if so, what are the longer term implications for that?
Outstanding question. Let's not forget, by the way, that central banks are there in order to help us through these kinds of situations. I think the key is that in the aftermath, that the central bank does have to work with other agents in economies to reduce what we know as moral hazard, so that we don't get markets or businesses or consumers always relying on the central bank to come to their rescue, so that they don't take personal responsibility as much for the outcomes. Now, that said, I think the translation of what you've asked is a great question. Are central banks providing almost a put or a floor on the price of assets to keep financial stability? And I think that's a very difficult question to answer. Jay Powell, and I think you know that I worked at the Federal Reserve from 2008 through 2012. Some of my partners at Northern Trust think I caused the financial crisis, but I personally think I was there trying to help things out. And my time there overlapped a little bit with Jay Powell's. And he was asked at his press conference a great question, which is that if he saw a bubble forming, would he tighten monetary policy to keep it from getting out of control? And he had a very simple answer. Central banks have a very, very concentrated set of objectives. Control inflation, which means getting it to about 2% in most markets, and then promoting employment. And if those two are not satisfied, he could not envision a day where the central bank would enforce discipline by trying to rein in an asset bubble, which is difficult to diagnose. I do think that we're more vulnerable to them now than we were before, but I'm not sure what's to be done about them.
And you're right, central bank mandates are somewhat clear, but there is a question of their evolving nature as well, and greater level of responsibility. And this really leads on to a question about the possible socialization of a debt pile. You talked about deflation and Japanification, where obviously a country like Japan has seen a huge intergenerational debt burden. How long and should these types of policy measures continue? And who do you think will ultimately pay the bill? Or is there a possibility of some sort of free lunch?
Well, I wouldn't call it a free lunch, but if the policies work, everybody will be better off than if we had another depression. But that said, I mean, certainly there is a lot of discussion about how low interest rates harm savers. We do have a demographic challenge in a lot of parts of the world. In most major Asian countries, the fastest growing segment of the population is above the age of 80 years old. And if you carry that out, they are living on their savings, and they're typically not taking a lot of risk in their retirement. So their ability to sustain themselves is going to, I think, be a very big challenge for a lot of societies. I think the other group that's not helped by the current circumstance are people who are in debt, and this would include countries. As it said, inflation actually makes debt more manageable. And when you have low interest rates and low inflation, the real value of the debt is higher. Everybody with me? So that makes it harder to pay back with inflated dollars over time. And so again, I think given the debt burdens I see in a lot of places around the world, I do worry about how well those will be kept up.
Now, Carl, I can't avoid this question too much longer, but obviously you touched upon the souring state of international relations, and we're all very aware that things are getting worse between the US and China. Do you think the upcoming US presidential elections will have a big impact on how this pans out over the next 6 to 12 months?
Well, it's, I think, been a great pity what we've seen over the course of the last couple of years. What I tell my clients in the East and in the West is that they perhaps don't understand how interdependent China and the United States have become. China owns, I think, $1.3 trillion worth of US Treasury securities, and we're glad that they do. But by the same token, if they didn't buy them, then perhaps the United States wouldn't buy as much from China. Without the collaboration of those two countries, our progress on issues of world health, of climate, of debt sustainability in emerging markets, of setting standards for technology in the years ahead is going to make it much more difficult for all countries in the world to achieve what they potentially can. Now, I understand that basic tenet that free trade works best when it is fair trade, and that certainly there are grievances that arise between any two countries in situations where that balance is not kept up. But certainly the acrimony between the United States and China has been brewing for a long time, even prior to 2016. But I do think it has been exacerbated by the policies and personalities involved. Now, Adam, I will tell you that part of the edge that we are seeing, I think, from both Beijing and Washington, are born of politics. We have the election coming up, and for certain communities in my country, villainizing China is a vote-getting strategy. I think more, I won't say rational, but more people who view things with a bit more balance understand that that's probably not the right policy long term. But we're going to have that at least until November, so I would not expect anything to thaw until well after the election. Now, certainly there are two different trajectories if Mr. Biden is elected or if Mr. Trump is reelected for international relations, but I wouldn't expect that it will go back to where it was prior to 2016. I think there's some hard work to do. There are formulas that will get there, but I think both sides have to be willing bargainers. And for the Chinese side, as I mentioned before, they're going through one of their roughest economic times in a generation. And I think President Xi is trying to, manage the will of the mood of the people, and in some cases, pointing a finger, outside of the country is one way of doing that.
Yes, there are a multitude of challenges for both countries, aren't there? Now, with that growing tension and rivalry, how do you see financial centers like Singapore navigating this?
So there are so many innocent bystanders as the two titans battle it out, and it's a very, very thin fence to straddle, where you have each side that is asking allegiance. And certainly when you have areas like Singapore or Hong Kong or others around the Far East that are nexuses of global supply chains and trade, this is almost a nightmarish situation, because until all of this gets resolved, it's going to be very difficult to attract the business mass that's been relatively easy to attract during the last generation. And so, I think patience is going to have to be a watchword, and I think watching that political and economic landscape very carefully is going to be absolutely essential.
Yes, and we have one final question from one of our attendees, but there have been reports that President Trump might just call it a day. Do you expect US policies, including international, to change substantially if the Democrats perhaps win the presidential elections, or if there is another Republican candidate?
Those reports, I did see them this morning, and of course, my politics have to be, a closely guarded secret. So I certainly wouldn't betray whether that would be good news or bad news. That certainly, for some in this country and internationally, would be a little bit of both. But I think one thing I would point out is that while the style of our current president is certainly unprecedented, I think what I tell my clients in Asia, and that I would stress, is that if Donald Trump goes away, some of the attitudes in the United States towards trade are not going to go away, because there are communities in this country who have not felt the benefit of free trade. In fact, they blame it for some of the struggles that they have had in their lives, for employment, jobs going elsewhere. And so unless and until we have a narrative to those people who have been displaced by trade all over the world, the ability of leadership in any of those countries to embrace a truly global model again is going to be somewhat limited. And so if I were to make a recommendation to regimes all over the places, don't just dismiss people who feel like they have not benefited from trade. Listen carefully and try and find a way that they can share in the opportunity as well as in the bounty that comes from true globalization.
Yes, I agree. There are some very deep-seated issues both in the US, and I think there's some similarities with the UK and the Brexit vote. It's not just simply leaving the EU that's going to resolve all those, and obviously Boris Johnson came in on quite a strong mandate to do that, but I think he's very quickly realised he doesn't really want to be the Prime Minister, and there's an awful lot of planning and preparation that needs to be done, which isn't really his forte. So I think we've come up to our time, Carl. I've really enjoyed our conversation, and thank you for your honest and comprehensive insights as well. I hope you found the discussions productive also.
I absolutely did. It was a treat to join you, and I hope those listening found it beneficial.
Thank you, Carl. Well, yes, I do also want to thank all our listeners for joining us and contributing to the poll questions today. We'll publicize a edited form of this recording on our website as well, and so please feel free to just distribute it to colleagues who weren't able to attend. But from me here in Singapore, I'd like to say thank you to Carl once again, and also thank you to our listeners, and to all of you, wherever you are in the world, please stay safe. Thank you.